Now, when ANZ Bank sought to buy out Suncorp's banking operation, there was disquiet in an already concentrated industry. Though there are more than 90 banks in Australia, the Big Four dominate deposits and mortgages. But previously, the Commonwealth was allowed to take over Bankwest. Westpac was allowed to take over St George. The ACCC knocked back the ANZ's offer, but the Australian Competition Tribunal, a little over a week ago, overturned that decision. Suncorp now is set to become a pure insurer, a business that's been good in the past 6 months with higher premiums, better investment markets and fewer weather-related natural disasters. Well, this week I spoke with Suncorp Chief Executive Steve Johnston and started on that controversial ANZ deal.
Well, it obviously allows us to reach that ambition that we've had. The rationale for selling the bank was to create a pure play insurer, trans-Tasman insurer, so that every dollar of our capital can go into improving the way we deliver insurance services. So that's the ambition that we had. That's the rationale that underpins it. One step closer to delivering it.
OK, the $4.9 billion. Just explain what you're going to do with that money.
Well, the intention is to provide that back to shareholders. Obviously, there's some what we call frictional costs. There'll be some costs of the transaction that we've got to work our way through, and that sort of nets itself off to around $4 billion. And subject to the needs of the business, which is always a caveat that we apply, we'll be giving that back to shareholders either late this calendar year or early next calendar year.
I was going to ask you more about the needs of the business, because it's always one of these things with capital. It's hard to raise, but you've now got it there. So it's a matter as to whether you want to make acquisitions, whether you need to, shore up the business in some ways in terms of your own capital, which is also already reasonably strong. So where do you, as a company, see the priorities?
Yeah, we've been shoring the business up for the past 3 or 4 years. We've been remediating portfolios. We've been simplifying the group. We are back investing in the business. We've made a lot of investments over the past 2 or 3 years, but we've done it within the guide rails for profitability. So it hasn't been a customer trade-off against shareholder. Both can coexist, and that margin guidance that we've got allows us to invest in the business. So we don't have any overarching ambition to, head down some inorganic path or anything like that. We're focused on simplifying the business and just delivering the best insurance business that we can.
Is Suncorp a better business without the bank?
Look, it's very hard for me to say. I'm a big fan of the bank. It's Suncorp's heritage, so it's a bittersweet moment when we say goodbye. We didn't wake up one morning as a management team and say we want to sell a bank. We did it because there was a clear objective behind it and a clear agenda that we needed to pursue to allow us to do better in insurance. Insurance has become more capital intensive, climate change is coming, frequency and severity of weather, and the demands of having a very capital intensive bank and a capital intensive insurance company just couldn't coexist. That's the strategic rationale for it. So I think Suncorp will be a better organisation, and so will Suncorp Bank within ANZ.
So let's go to the insurance side of your business. In insurance terms, you've had a relatively quiet year in terms of weather, in terms of claims experiences, which is one reason why your results are so good. The second thing is you've passed on a lot of increased costs, inflationary costs, by way of higher premiums, and insurance has been one of the big contributors to many people's feeling of inflationary impacts in their households.
Well, we had a pretty horrendous December. We've had a couple of cyclones and some big events, obviously, through the latter part of the year, but we have landed below our allowance. But equally, our allowance has doubled over the past 5 years, so we're far more robust around how the way we plan for weather events. And yes, we have passed on pricing, but that's input cost related. We've had, on average, more than 100,000 claims per year, around $10 billion worth of natural hazard costs over the past 5 years, and the cost of our hazards and reinsurance program has gone from $1.9 billion to $2.9 billion in just 5 years. So that's 54% increase. So they're the sort of input costs alongside general economic inflation that we've had to somewhat pass through to consumers, and we've tried to make our business more efficient so that we don't pass all of those on, that we're taking some of the weight off our customer base.
But you'd recognise the pressure on your customer base, because the higher those premiums, the more that people decide we'll opt out.
Yeah.
And so that makes your whole portfolio, your pool of investors or insurance people, that makes it weaker and therefore pushes up costs even higher.
Yeah, and it's a human being scenario as well, because I go out after all these big events and I sit down with customers in their homes and I look at them and say, well, at least we can take some of the pain out of this event for you because you've got insurance. Our objective as an insurance company and the industry more broadly should be to maintain maximum cover. The more people that are covered, the better the insurance industry is, and it's better for the nation as well. So we've got to, as an industry, find ways of doing more, being more adaptive, being more innovative, design new products and try and take the weight off affordability.
But you understand that there are parts of Australia after multiple natural disasters or weather events where people either can't afford or simply don't have the ability to get insurance. So does that become the obligation of government to provide the cover for those people?
Yeah, I mean, there's a lot of people who built homes in places where they should never have built. And they did that in good faith. They got an approval from a government agency and they built a home there, and ultimately they should never have built there. So we've had a 4-point plan: improve public infrastructure, subsidies to support consumers who lift and do different things to their home to make their home more resilient, stop the planning law debacle in the country, and take taxes off insurance products. Again, I put a presentation to the market today and indicated that Suncorp in 2023 collected over $1 billion worth of levies, stamp duty, emergency services levies, that's off the base premium. So if you've been put in one of those homes in the wrong place, you pay an insurance premium reflective of risk, and then you pay goods and services tax, you pay a stamp duty, and you pay emergency services levy. And that doesn't seem right.
So then there's another aspect of this, and that is that quite clearly in Queensland you've seen the government step into the reinsurance pool to make sure that you can at least be covered if you offer policies to people in some of these areas. Do other states need to follow that, because they have other people in very vulnerable positions as well?
Well, I don't support extending the pool any further, because I think what the concept of these pooled arrangements are is they just defer what we need to do as a nation, and that is to invest in making our country more resilient. If we continue to paper over it with taxpayer dollars, we won't make the changes that we need to create a long-term sustainable Australia. And so the cyclone pool is one example, and it's had mixed reviews so far. We've got to wait and see. The jury's still out on whether it's successful. But I think the basis of the government intervention should be in reducing the risk, because when you reduce the risk, you'll reduce the price.
Okay, so one other area where you've had to push up premiums is in motor insurance. Now, the reason why is because vehicle repairs have gone through the roof. Is there any sort of sense that those price increases that have happened over the last 18 months to 2 years, whether they're starting to come off?
Well, I think the rate of increase is starting to slow as inflation starts to come out. So think about a car today versus a car of 10 years ago. You replace a bumper bar today and it's got sensors, it's a big job, versus a bumper bar of 10 years ago. Think about the repair networks. Now, Australia's repair networks have relied on migrants, workforces and apprenticeships. And during COVID, they were furloughed for 3 or 4 years. You just can't turn it back on overnight. So some of these are a little bit specific to motor insurance and motor repair costs. They will mitigate and they will moderate, and they are doing that at the moment. So I'm hopeful that over the next 12 to 18 months, you're going to see the rate of increase in motor vehicle insurance start to come off.
Just one quick off-the-cuff one for you, and that is that with the rise of electric vehicles in Australia, what does that do to insurance premiums long term?
Well, again, the jury's a little bit out on that one, because we saw in the early days of electric vehicle adoption, frequency, which is the rate of accidents in the fleet, significantly above all other cars. Teslas were having sort of almost 2 times the number of accidents. That's the different driving patterns of electric vehicles. That started to come back to the normal fleet average now. The costs, depending on whether the batteries are impacted, can have differences relative to internal combustion engines. So it will settle down over time, but at the moment we're seeing some distortions between frequency and average repair costs.
So what you're telling me is if I've got an electric vehicle, the likelihood is I'm paying more for the insurance for that vehicle as I would for a traditional vehicle.
You may pay slightly more at the moment, but I think over time that will come back to the normal fleet average.
Steve Johnston, always good to chat to you. Many thanks for your time today.
Thanks, Ross.